All right, let's talk about something in accounting that trips up a ton of people. It's one of those things where confusing a few simple words can create a total disaster. Today, we're going to unpack three of the most dangerously mixed up terms out there: provisions, estimates, and reserves. Because if you get this wrong, you could be looking at a company's future and getting the story completely wrong. So picture this. You're looking at a financial report and you see these two phrases: a provision for bad debts and an estimate for uncollectible accounts. They sound pretty much the same, don't they? Both seem to be about getting ready for customers who, well, aren't going to pay. And you know what? That totally logical assumption, that's exactly where the danger starts. So what's the deal? Are they the same thing? And honestly, why should you even care? Because look, getting this right isn't just some bean counter detail. It's for anyone who wants to know what's really going on inside a company. And that story, as you'll see, can be wildly different from what it looks like on the surface. Okay, so to really get a handle on the risk here, we first need to figure out why this mix-up is so common in the first place. And it all comes down to a really basic principle of how modern business works. The whole reason this gets confusing is because of something called accrual accounting. All it means is that you have to record business activity when the deal happens, not necessarily when the cash hits your bank account. And because of that, you're always trying to predict the future, right? You're trying to account for things that haven't happened yet. And that's why we need things like estimates and provisions. And hey, don't feel bad if you're confused. This isn't just some small mistake. It's so common that even major legal documents, like Mexico's own income tax law, get it wrong. They use provision and reserve like they're the same thing. Now think about that. If the law is confusing, you can imagine how risky that is for a business that's just trying to do the right thing. All right, so if the official rules can be messy, it's up to us to get crystal clear on this. So let's do it. Let's break down each of these terms: estimates, provisions, and reserves. We'll look at what they are, what they actually do, and where you'll find them on the balance sheet. Okay, first up, estimation. This is all about an asset, something the company owns or is owed. Let's say you have $10,000 in receivables, which is money your customers owe you. An estimation is basically you looking at that and saying, you know what, I'm probably not going to get all of that. So you record an adjustment because you expect less cash to come in. Next, we have a provision. Now, so what you're thinking, this isn't about an asset. It's a liability. This is money you are pretty sure you're going to have to pay out. The catch is, you don't know exactly when or exactly how much. A perfect example is a warranty. You sell 1,000 products, you know a certain percentage are gonna come back for repairs. You have to account for that future cost. That is a provision, a known future cash outflow. And then there's the reserve. This one's the odd one out because it's in a totally different category. It's not an asset, it's not a liability. A reserve is part of the company's equity. It's a slice of the profits that the company decides to hang on to instead of paying it out to shareholders. The board might say, hey, instead of giving this all out as dividends, let's put $1 million into a reserve for future expansion. It's a choice to keep the cash inside the business. Okay, I know that was a lot of accounting talk. So if you remember one thing, remember this. It's the simplest way to cut through the jargon. Is it about getting less cash in? That's an estimation. Is it about cash going out? That's a provision. And is it about cash being kept by the company? That's a reserve. In, out, or kept. That's the whole game, right there. And if you look at where they live on the balance sheet, it just makes perfect sense. An estimation sits on the asset side. It's a contra asset, basically chipping away at an asset's value. A provision? That's over on the other side, as a liability. It's something the company owes. And a reserve, well, that's not a liability at all. It's tucked away inside shareholders' equity. It's part of what the owners actually own. So you see, they're not just different words. They're in completely different financial worlds. Okay, so now we get the difference. But let's talk about the so what. Why does this matter so much? Because getting these numbers wrong, man, it's not just a little clerical error. It paints a completely twisted picture of the company's health, and it can fool everyone from the managers to the investors. And the stakes here are really, really high. As financial expert Salvador Garcia Briones puts it, these errors ultimately lead the company's shareholders to make the wrong decisions. And that's exactly what it is, a domino effect. Bad numbers lead to bad decisions, and bad decisions, well, they can sink a company. So let's play this out. What happens if a company is too optimistic and books too little? On paper, things look amazing. Profits are up, key metrics like EBITDA look fantastic, but it's all a mirage because under the surface, you've got these hidden liabilities just waiting to pop. The company is basically showing everyone a beautiful picture that's completely fake. But what about the other way around? Booking too much is just as bad. Now your profits look artificially low and performance seems way worse than it actually is. This creates fake liabilities. And on the financial side, it can get really shady. People can use this trick to hide the fact that they're siphoning money out of the company. So you can't be too optimistic, you can't be too pessimistic. It's a tightrope. So how do you walk it? Well, it all comes down to having a solid, disciplined process. Let's walk through an expert's checklist for making sure these numbers are reasonable and, just as important, defensible. Look, there's no magic bullet here. It's all about doing the work. So, number 1, monitor your key accounts monthly. Don't wait a whole year to find out you have a problem. 2, if you see something wrong with your internal controls, fix it immediately. That's your smoke alarm going off. 3, keep an eye on the market. Are we heading into a recession? Is your biggest client looking shaky? That stuff matters. 4, make sure your forecasting methods actually work. Have they been reliable in the past? If not, why are you still using them? And finally, number 5, use statistical tools. Don't just go with your gut. Bring some real data into it. That's how you turn a guess into a solid forecast. At the end of the day, it's pretty simple. Your financial statements are telling a story about your business. And getting estimations, provisions, and reserves right is what makes that story fact instead of fiction. So the real question to ask yourself is, are your financials telling the truth? Thanks for tuning in.